So with that in mind, what's going on with housing in the US and more of this, particularly locally as well. Drew Bowie from MA Financial joining us with a view as to, well, whether we'll get a hard or soft landing. Drew, welcome.
Thank you, Andrew.
It's a big question, isn't it? Perhaps if we look at what's going on in the States at the moment, where that Fed funds rate is going, you could argue that the States is already in recession. So how's that playing out as far as the residential property market's concerned?
So I think there are a couple of main factors that are causing the concern for the local market. That is, if you think about over the past 10 years, since interest rates started to fall quite dramatically, we've seen a circa 30% increase in the long-term trend for residential values. So that's causing a concern of what goes up, can it come down? And secondly, we have about 10% of the Australian mortgage market that's coming off a very low fixed rate over the next 2 years. So those interest rates may increase by upwards of 3 times what borrowers are currently paying.
Do you have any particular concerns, particularly as those roll over? And also the fact that I guess many first home buyers got into the market potentially at the top, maybe highly leveraged. As we see those rates continue to rise, that we will see more distress as far as those repayments are concerned.
Well, those people who did buy at the top, they were also stress tested by their lenders at an interest rate of almost 6%, 5.5%, 5.75%. So they have quite a way to go before interest rates do get up to that level and they start to see a significant amount of pain. I also note that about 50% of the mortgage market is 2 years ahead of their minimum interest payments. So again, there's quite a bit of buffer there. Anyone who bought before that peak has probably seen an increase in their asset values of about 20% by doing nothing anyway. So the question becomes, who is going to suffer? Those people who bought at the peak need to sell at the bottom. Who is that? People who really are going to lose their jobs. And when unemployment is so low, the likelihood of that happening is low.
Well, I guess that brings you to the question of whether Australia is likely to fall into recession. Then we will see unemployment rise and therefore put pressure on those people that are vulnerable in the housing market. But I mean, I guess you look at where property values are going at the moment, precipitous falls. Certainly we've seen forecasts just in the past day or so from some economists saying 25% in Sydney, but then factor in where they've been over the past couple of years. Nonetheless, at the lower end, do you feel as though people are going to have negative equity in their homes?
Well, it's very hard to predict what is going to happen in the future. There's a very wide range of views on interest rates, and that is why we offer a real estate credit investment, because real estate credit means that we're not riding the volatility of an owner of property. We're in a last loss defensive position in the capital stack, which means it is a defensive investment whilst the markets are volatile.
All right, so a credit investment, just explain that to us, what that looks like and how you can get a piece of that.
So you think about your house and having a mortgage against your house. You borrow and that lender secures their position by a mortgage over that real estate asset. And that mortgage ranks ahead of you, ahead of your equity. There are various types of credit. We deal at MA Financial in first mortgage credit, which means our money is most secured on behalf of our investors. So if the borrower was to default, if the borrower did lose their job, was under stress, our asset and our investment is still protected by the low level of gearing that we have against that investment, which is upwards of about 65% of the value of the property. So we can withstand significant falls in asset values.
Are you arguing perhaps that it's potentially a defensive investment?
It's very much a defensive investment. It's suitable for people with low to moderate risk tolerances. And again, that is because it withstands the volatility in the property value cycle.
All right. If you want to go down that path, then what's the best way to do it? And particularly, I guess, as far as picking a manager?
Choosing a manager is very important. Cycles happen. We're aware of that. They always happen. They will continue to happen. So choosing a manager that has seen cycles, that have been around for many of them, so can understand what action to take when things are happening. It also, it's important to understand people who can ascertain the underlying value of the property. Getting that right in the first instance is critically important.
How do you do that in a market where it's falling?
Understanding how values can be affected, understanding the market data, not pushing where you need to push. I think it's critical to have a lender, have a manager, that is multidisciplined. So has businesses outside of just the real estate markets. That means that when the time is not right for investing, they're not forced to invest.
And when you break it up regionally, perhaps in Australia, are there preferred areas that you would like to be invested as far as credit is concerned?
When we choose our investments, we're looking for markets where there's fundamentally a strong demand for that asset, so a large buyer pool for that asset. So if we were in a position where we needed to sell that asset, we know that there would be a large buyer pool, as I said.
So Drew, you're obviously very mindful of where the RBA is taking rates at the moment. Do you have any particular forecast there? I guess, there are so many variables at play at the moment.
There are so many variables. One thing I will add is that about a year ago, we started offering only floating rate investments to our borrowers. That means as the cash rate changes, we capture that increase in income as it's increasing.